Hello and welcome to another session of the My Solo 401k Financial, My Community YouTube series, webinar series. Thank you so much for joining. If you're watching on YouTube, please like and subscribe for more videos like this. You certainly can, you're more than welcome to ask questions in the comments. We are going to go through the slides first, and then we'll turn to any questions or comments. Thank you so much for joining. So today's topic is a great topic. We're here today to talk about solo 401k contributions. And a common question we get is, how much income do I need in order to maximize solo 401k contributions? So we're going to be focused on businesses that are taxed as sole proprietors or single member LLCs, individuals that report their income on Schedule C of their taxes. So if you're not able to stay for the whole session, that's fine. If you just come back to this link on YouTube, you'll be able to watch the recording. Again, if you subscribe, you can get notifications of all of our webinars as we regularly host webinars here. So first off, the presentation is being provided for educational purposes only. Should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Just want to highlight, this is a series that we're going through now regarding how much income one would need to be able to maximize contributions. Most recently, we hosted one on this same topic that was geared towards businesses that are taxed as an S Corp or a C Corp. We'll be hosting another one focused on businesses taxed as a partnership, like a multi-member LLC. Today, of course, is sole proprietors or single member LLCs, independent contractors, those who report their income on Schedule C of their 1040. Also on the horizon, we've got some solo 401k deep dives. We want to go deep on a couple of different topics. One would be solo 401k establishment process. Another would be the solo 401k loans. And, a current topic that's very getting a lot of questions would be just the recent announcement that Vanguard is exiting the solo 401k business. Recently, we hosted a deep dive discussion talking about options for existing solo 401k account holders. If you go back to the YouTube page, or if you just go to mysolo401k.net, from the homepage, we have a link to a resource hub for those existing Vanguard solo 401k account holders, just going through different options in terms of costs, investment options, whether those folks want to stick with a census or maybe switch over to a different provider. So we put a lot of resources together for that population. So just to give us a quick overview of where we're headed, I want to talk about the solo 401k basics in terms of eligibility, some of the top use cases. And then as we get into this question about how much self-employment income I would need in order to maximize solo 401k contributions, it's going to be good to lay the foundation as far as, okay, well, how do you determine how much you can contribute? Which then that brings up, okay, well, what are the contribution factors? What are the limits, right? And then answering that question is not the same for every person. So we want to talk about different scenarios, right? Like some folks might want to focus on making pre-tax contributions, whereas other individuals might want to focus on making Roth contributions. And then we're going to add some bonus content, which is just to let you guys know about the $1,500 solo 401k tax credit. So, and then of course, resources would be our community, mysolo401k.net/my community. We host daily Zooms. Of course, today's session is here on the YouTube channel, but you could link to the same webinar from the community. It's always free to join. All are welcome. We have forums on there where individuals are posting questions 24/7. You can also find a deep dive or a deep library of deep dive webinars, videos, etc. So there's great ways to learn and to share the knowledge. So just to start to get into the topic, right? Solo 401k eligibility. In order to be eligible to set up a solo 401k, you have to be self-employed with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. You do not need to have a separate entity, right? You could be a sole proprietor. We have many individuals that are sole proprietors. You can, of course, have an entity for your business. Ultimately, the key is that you're reporting earned self-employment income on your taxes. So that would be Schedule C on your 1040, For example, for a business that is taxed as a sole proprietorship, or W-2 wages, for example, for a business that is taxed as an S corp. There's no minimum amount of earned self-employment income that you would need in order to be eligible to set up a plan. But of course, if your goal is to make contributions, as you'll see when we get into the slides, right, you need to have self-employment income to justify the contribution. The whole point of any type of 401k is for individuals who work to save for retirement. A solo 401k is for a self-employed person, but it still comes back to that notion of having earned self-employment income that one is then saving for retirement, right? So you have to have the income in order to save it, right? You can't save more than you earn. You have to have the income to justify the contribution. A spouse or business partner may also participate in the solo 401k as long as the spouse or business partner is reporting their own earned self-employment income, such as a separate Schedule C or maybe a separate W-2. One can have a solo 401k even if they have a W-2 job, even if they participate in their W-2 employer-sponsored plan, as long as they've got that separate earned self-employment income. As far as some of the top use cases, one would be contributions, because the solo 401k has the highest contribution limits for any defined contribution plan available to self-employed individuals. For example, for 2024, someone could contribute up to $69,000 or even $76,500 if they're 50 or older. And then if they have a plan like ours that allows for it, they can make those contributions as pre-tax contributions to reduce their taxable income, or they could make those contributions as Roth or mega backdoor Roth contributions, where they're not going to be able to reduce their taxable income for the year for which they make the contribution, but they have the potential for tax-free growth. Other top use cases would be alternative investments, where the individual with our plan can invest in things like real estate, cryptocurrency, private placements, notes. And as part of the establishment process, we're helping our clients open up accounts for their solo 401k at the bank or brokerage of choice, where they have checkbook control over the money. Having that checkbook control can be instrumental in being able to act quickly on those investment opportunities. And then finally, one of the top use cases is being able to take a solo 401k loan. So this is where one can literally take the funds from their own solo 401k account and use them for any purpose whatsoever. It could be an emergency fund. They might want to, rehab their own residence, etc. Ultimately, it's not going to be considered a taxable distribution as long as it's properly documented as a loan, and we handle the loan documentation requirements and pay back according to the payment terms. So the payment terms is they would be able to borrow up to 50% of the balance, not to exceed $50,000. It needs to be paid back in either monthly or quarterly payments, equal payments of principal and interest. The interest rate is going to be prime plus 1%, or it could be a CD rate plus 2% with those payments spread over a 5-year term. So now let's start to dig into how much income I would need in order to be able to maximize solo 401k contributions, right? So that then raises the question, well, how much can I contribute, right? What are the solo 401k contribution limits? And so one's ability to contribute to the plan is going to be based on different factors, right? One factor is going to be the self-employment income that the person reports. Another factor is going to be their age. Another factor is going to be the type of contribution that they're looking to make, whether it's employee, for example, versus employer, or whether it's pre-tax, Roth, or after-tax, because each of those different types has their own different limit. And then, of course, whether you make contributions to another plan, like a day job 401k plan, can reduce how much you can contribute. So we're fielding questions every day, educating our customers on the rules and how it applies to their situation. So with today's focus being businesses that are taxed as a sole proprietor, a single member LLC, someone who receives a 1099 as an independent contractor and reports that income on Schedule C, self-employment income means line 31 of Schedule C, so your net income after your business expenses, less 1/2 of the self-employment tax. So in other words, you have to run a pre-calculation to first determine your self-employment compensation. And in determining your self-employment compensation, you can only use your self-employment income to justify solo 401k contributions. In other words, you cannot use W-2 wages from another source like a day job. You also can't consider investment income that you might receive, for example, income reported on Schedule E of your 1040. So this is a good slide as it illustrates that calculation, right? You take your net income reported on line 31 of Schedule C, less 1/2 of the self-employment tax. And we have a Solo 401k calculator on our website that'll run this calculation for you. So if you go to mysolo401k.net, there's a menu that goes left to right, home, about, Solo 401k. If you go all the way to the right under learn and then click on online tools, you can easily find the Solo 401k calculator. And then of course, when we're continuing to, explore, okay, what are these contribution limits? We also have to consider the overall limits. So for 2023, the overall limit is $66,000 plus an additional $7,500 if you're 50 or older. The limit was raised for 2024 to $69,000 plus another $7,500 if you're 50 or older. So now let's continue to explore these limits, right? As we alluded to, right? Your ability to contribute to the plan depends on different factors. One of those factors is, well, what type of contribution are you looking to make? So the first type is employee. So an employee contribution is also referred to as a salary deferral. It can be made as a pre-tax contribution, or our plan would also allow the individual to make it as a Roth contribution. So the limit in terms of pre-tax employee contributions is 100% of your self-employment compensation. Remember, self-employment compensation is equal to line 31 of Schedule C, less 1/2 of the self-employment tax, up to $22,500 for 2023, plus an additional $7,500 if you're 50 or older. Now, the individual would need to reduce that contribution by any contributions made to another plan, like a day job plan, because the employee limit applies at the employee level. So if someone maxes out contributions to their day job plan, they're not going to be able to make any more employee contributions to the solo 401k plan, unless the other plan is a 457 governmental plan. So we still have individuals that are making employee contributions for 2023. For example, if they set up their plan on or before December 31st of 2023. For 2024, the limit increased to $23,000 or an additional $7,500 or $30,500, in other words, if you're 50 or older. As I mentioned, this employee contribution could also be made as a Roth contribution. In that case, that Roth employee contribution would need to go into a separate sub-account. Now, the second type is an employer contribution. Another name for that is a profit-sharing contribution. The limit is a percentage of your self-employment compensation. So for a business that is taxed as a sole proprietorship, a single member LLC, a 1099 independent contractor where income is reported on Schedule C of the 1040, we have to first run that pre-calculation of determining your self-employment compensation, where we take line 31 of Schedule C, less 1/2 of the self-employment tax. And then of that number, 20% can be contributed as an employer contribution. Now, of course, the total amount of solo 401k contributions cannot exceed the overall limit, right? So the sum of any employee, any employer, any after tax that is being made to the solo 401k cannot exceed the overall limit, right? That is $66,000 for 2023, plus an additional $7,500 if you're 50 or older, $69,000 for 2024, plus an additional $7,500 if you're 50 or older. So unlike the employee limit, where that limit applies at the employee level across all plans that the individual is making contributions to, the employer contribution limit applies at the plan level. It applies at the employer level. So that means if a self-employed individual is making, say, contributions to a day job 401k plan, let's say they maxed out their contributions to their day job plan, they're not going to be able to make any more employee contributions to the solo 401k, but they can still make employer contributions based on their self-employment compensation, right? 20% of that self-employment compensation. So in other words, it's not impacted by contributions made to another plan sponsored by an unrelated employer, like a day job 401k plan. Now, one exception to that rule would be the 403b exception. So if someone is making contributions to a 403b, or if contributions are being made on your behalf to a 403b, you have to aggregate all the contributions that are made to the 403b, whether it's employee or employer, together with any contributions that you want to make to the solo 401k, and the total cannot exceed that overall limit. So one question that does come up is the fact that under Secure Act 2.0, one question that comes up with respect to employer contributions, these profit sharing contributions, is whether or not they can be made as Roth contributions. So it is correct that under Secure Act 2.0, employer contributions can now be made as Roth contributions, assuming you have a plan like ours that allows for those employer Roth contributions. It's noteworthy, though, that for our plan, right, based on our experience and our customer feedback, where our plan has already, before Secure Act 2.0 was enacted, allowed for mega backdoor Roth contributions, many of our clients choose to simply make voluntary after-tax contributions and then move the funds from the after-tax solo 401k sub-account to either a Roth solo 401k or Roth IRA, and decline to make employer contributions as Roth contributions. So even though they now have the ability to make those employer contributions as Roth contributions, we're not seeing a lot of clients do that. And why is that? Well, number one, the voluntary after-tax contribution limit is higher than the employer contribution limit, right? We just saw that the employer contribution limit is a percentage of your self-employment compensation. It's 20%, whereas the voluntary after-tax solo 401k contribution limit is 100% of your self-employment compensation, subject, of course, to the overall limit. So you don't need as much self-employment compensation to justify the contribution that you want to make. Another reason is that the deadline is the same, right? Regardless of whether you want to make after-tax solo 401k contributions or employer contributions, it's the same. Like it's the business tax return deadline, including any timely filed extension. So technically, even if someone didn't set up a plan by the end of 2023, if they filed an extension for their 2023 business tax return, they could still set up a plan and make either employer contributions for 2023, as well as voluntary after-tax contributions for 2023, anytime up until their business tax return the extended deadline here in 2024. So for example, for a business tax as a sole proprietor, where the income is reported on your 1040, if an extension was filed for the 2023 Form 1040, that would give that individual all the way up until October 15th of 2024 to set up a solo 401k and then make either voluntary after-tax contributions for 2023 or employer contributions for 2023. Finally, as far as why we don't see many individuals making employer contributions as Roth contributions is because you have more flexibility with voluntary after-tax contributions. So for example, voluntary after-tax solo 401k contributions can be transferred out of the plan to a Roth IRA without having to meet a triggering event, right? Normally, before you can transfer funds out of your solo 401k out of the plan, even if it's going to another retirement account, you have to meet a triggering event, for example, being age 59 and a half. And that requirement would apply to employer contributions made as Roth contributions. A triggering event would have to be met. But there's an exception to that general rule, which is voluntary after-tax contributions, if you have a plan like ours that allows it. So those voluntary after-tax contributions can be deposited into the separate voluntary after-tax solo 401k account and then transferred out to a Roth IRA. So that would be another reason that we're not seeing as many folks really take advantage of the new rules that allow for employer contributions to be made as Roth contributions. But it still begs the question, well, if I do make employer contributions as Roth contributions, do I need to deposit those into a separate account? Well, they certainly need to be deposited into a separate account for Roth Solo 401k funds, but it could be the same Roth Solo 401k account that the individual is making employee contributions as Roth contributions. What is the contribution limit? Well, we saw that it's 20% of the self-employment compensation. And then how do I report those employer Roth contributions? Well, this was a big open question when Secure Act 2.0 was enacted, at the end of 2022. because the IRS didn't come out with guidance as far as how to report those employer contributions as Roth contributions until almost a year later, right? Up until then, employer contributions were always made as pre-tax contributions. So they would be tax deductible on the employer's return. So the IRS finally answered the question again almost a year later. And per IRS Notice 2024-2, Roth employer contributions are reported as tax deductible on the employer's tax return, in other words, the 1040, for the year for which the contribution is made, but then reported as taxable to the employee for the year for which the contributions are deposited. So remember, I stated that one could, if they filed an extension for their 2023 1040, it's still possible to make employer contributions up until the extended tax return deadline. It's still possible to set up a plan and make employer contributions up until the extended tax return deadline of October 15th. So if someone were to set up a plan, make employer contributions as Roth contributions, say by September or October of this year for 2023, that would be reported as tax deductible in the 2023 1040, but then it would be reported as taxable to the employee in 2024 by issuing a 1099-R for 2024. So now the individual would essentially reduce their income reported on the 2023 return, but then have to raise it on the 2024 1040 because now they have a taxable event by making this Roth employer contribution. Okay, so then let's look at the voluntary after-tax solo 401k contribution limit. So here, the limit is the lesser of self-employment compensation. Remember, that's line 31 of Schedule C, less 1/2 of the self-employment tax, or the overall limit. So in other words, you can contribute 100% dollar for dollar of your self-employment compensation up to the overall limit, $66,000 for 2023, $69,000 for 2024. But you do have to, of course, consider that overall limit. So the sum of any employee and employer contributions that are made to the solo 401k, together with any voluntary after-tax solo 401k contributions, can't exceed the overall limit. Now, when calculating how much you can contribute, you actually don't have to factor in any catch-up contribution. So remember, a catch-up contribution of $7,500 can be made if you're 50 or older. So that catch-up contribution of $7,500 would not be made as a voluntary after-tax contribution. It would have to be made as either a pre-tax employee or a Roth employee contribution. So ultimately, someone that's 50 or older is still going to be able to contribute up to $76,500, for example, for 2024, even if they made a $69,000 voluntary after-tax contribution. Just the additional $7,500 would have to be deposited as either a pre-tax or a Roth employee contribution. So unlike the employee contribution limit, which is impacted by contributions made to another plan like a day job plan, the voluntary after-tax solo 401k contribution is not impacted by contributions made to another plan. So even if someone has maxed out their employee contributions to say their day job 401k plan, if they have the self-employment compensation to justify it, they could still make a $69,000 voluntary after-tax solo 401k contribution for 2024. Now, again, the exception to that general rule is the 403B exception. So any contributions that are made to a 403B, either those made by the employee or on these employees' behalf by the employer, together with any contributions that the individual would want to make to the solo 401k, whether it's employee, employer, or voluntary after-tax solo 401k contributions, cannot exceed the overall limit. And then finally, just like with Roth solo 401k contributions, voluntary after-tax solo 401k contributions need to be deposited into a separate voluntary after-tax solo 401k account. This is how one ends up with 3 different accounts, right? A pre-tax, Roth, and voluntary after-tax, or maybe 6, right? If it's a husband and wife, it each has a pre-tax, Roth, and after-tax sub-account. Okay, excellent. So now that we've laid the foundation, let's start to go through different scenarios to answer that question of how much self-employment income I would need in order to be able to maximize contributions. And again, we're focused on a business that is taxed as a sole proprietor, single member LLC, 1099 independent contractor that reports their income on Schedule C of their 1040. So let's assume it's that type of business. It's one person, one participant, who does not make contributions to another plan like a day job plan And let's assume that their goal is they want to contribute 100% of their self-employment compensation to the solo 401k. So they want to keep their self-employment income as low as possible, and they're only going to make employee contributions. So of course that means that let's just, they're not making contributions to another plan like we assumed. So remember, self-employment compensation equals line 31 of Schedule C less 1/2 of the self-employment tax. So if they're under 50, right, and they want to contribute 100% of their self-employment compensation as an employee contribution, that means they want their self-employment compensation to be $22,500. So in that case, they would need to report on line 31 of Schedule C $24,749. So once they reduce that amount by 1/2 of the self-employment tax, that would give them $22,500, which they could contribute 100% as an employee contribution. It could be made as a pre-tax or it could be made as a Roth. They wouldn't be able to make any more contributions to the plan because they would have contributed 100% of their compensation to the solo 401k. So no employer, no after tax. So now let's talk about a situation where the individual is 50 or older. So in that case, they would want their self-employment compensation to be $30,500. They would want that compensation to be $30,500. So let's clean this up here. 1 second. Put a little typo. So they would want their compensation to be $30,500, right? Because remember, so they want if they're 50 or older, if they're under 50, they want their self-employment compensation to be $23,000. If they're 50 or older, it's going to be $23,000 plus $7,500. So this number is correct, right? For the first scenario, you need $24,749. Once you reduce that by 1/2 of the self-employment tax, that'll give you $23,000. Then you can contribute 100% for 2024 as an employee contribution. If you're 50 or older, right, the limit is $23,000 plus another $7,500. So that means your line 31 of Schedule C would need to be $32,819 because once you reduce that by 1/2 of the self-employment tax, that would give you $30,500. And then you'd be able to contribute all of it as an employee contribution, either pre-tax or Roth. In both scenarios, one would not be able to make any more contributions to the solo 401k because you ended up contributing all of it to the plan. So you couldn't make any more employer or after tax. Okay, scenario number 2. So this individual still wants to keep their self-employment income low, right? But it's not as low as possible, like in the last scenario. Here, the individual is willing to make employee and employer contributions, right? We're still focused on businesses that are taxed as a sole prop, single member LLC, 1099 independent contractor, doesn't make contributions to another plan like a day job plan. So here their goal is having self-employment compensation of $28,749 because now they're going to be able to put in $23,000 as an employee plus 20% of this same number, which is $5,749 as an employer, right? So that would take up all their self-employment compensation, right? The sum of the $23,000 employee plus the $5,749 employer would amount to 100% of their self-employment compensation of $28,749. So to end up with that amount of self-employment compensation, they would need to report $30,935 on line 31 in Schedule C. Because once you reduce this by 1/2 of the self-employment tax, it gives you $28,749 and allows you to contribute 100% of that amount between the employee and the employer. Now, if that person is 50 or older, they would need $38,124 of self-employment compensation, right? This would allow them to contribute 100% up to $30,500 as an employee, and then another $7,624 as an employer. So to have $38,124 in self-employment compensation, they would need to report $41,023 on line 31 of Schedule C. Because once they reduce this amount by 1/2 of the self-employment tax, the resulting number is $38,124, allowing them to contribute 100% to the solo 401k. $30,500 as an employee, $7,624 as an employer. Okay, so now let's go to scenario number 3. Let's assume this person is not interested in minimizing their self-employment compensation, but maximizing the contributions to the solo 401k. Right, again, still a self-employed business, taxes as sole prop, single member LLC, 1099 independent contractor, doesn't make contributions to a day job. So for this individual, they're going to want to put in, if they're under 50 for 2024, $69,000 to the solo 401k. And they want to make that as a pre-tax contribution. So that means they're going to have to contribute $23,000 as an employee and then another $46,000 as an employer. So to be able to justify that amount of contributions, they would need to have $230,000 of self-employment compensation, because 20% of $230,000 is $46,000. So in order to have $230,000 of self-employment compensation, they would need to report $243,717 on line 31 of Schedule C, because once they reduce that amount by 1/2 of the self-employment tax, that'll give them $230,000 in self-employment compensation. Now, if they're 50 or older, they would still that's the same amount of income they would need to report on line 31 of Schedule C. It would still give them $230,000 of self-employment compensation. It's just that now they would be able to make another $7,500 catch-up contribution as a pre-tax employee contribution. So this individual would be able to contribute $30,500 as a pre-tax employee, then another $46,000 as a pre-tax employer, resulting in them contributing $76,500 as a pre-tax contributions to the solo 401k for 2024. So now let's take a look at someone who wants to maximize the Roth Solo 401k contributions, either Roth Solo 401k as well as after tax that are then converted to a Roth Solo 401k from the after tax account. So again, we're focused on businesses that are taxed as sole prop, single member LLCs, 1099 independent contractors, doesn't make contributions to a day job 401k plan. So in this scenario, this individual would need, if they're under 50, $69,000 of self-employment compensation, because that would allow them to contribute $23,000 as a Roth employee contribution, and then $46,000 as a voluntary after-tax contribution, which they could then move from the voluntary after-tax solo 401k sub-account to the Roth solo 401k sub-account. So at the end of the day, they have $69,000 in their Roth solo 401k. Because remember, the voluntary after-tax solo 401k contribution limit is 100% of your self-employment compensation, dollar for dollar, not to exceed the overall limit, together with any other contributions that you make to the plan. So it's not a percentage like the employer contribution limit. So in order to have $69,000 of self-employment compensation, this individual would need to report $74,246 on line 31 of Schedule C. And then after they reduce that amount by 1/2 of the self-employment tax, they would now report $69,000, or they would now have $69,000 in self-employment compensation. So let's assume now the individual is 50 or older. They still want to maximize contributions to the Roth Solo 401k. So in order to be able to contribute $30,500 as a Roth employee, and then another $46,000 as a voluntary after tax, this individual, if they're 50 or older, would need to have at least $76,500 of self-employment compensation. So in order to have $76,500 of self-employment compensation, they would need to report $82,316 on line 31 of Schedule C, because then once they reduce that amount by 1/2 of the self-employment tax, that would give them $76,500 of self-employment compensation, allowing them to achieve their objective. Okay, so now let's spend a couple minutes on the solo 401k tax credit before we turn to the good questions. So the solo 401k tax credit is really part of the Secure Act. So under the Secure Act, certain tax credits became available to businesses to encourage them to offer 401k plans. Some of those tax credits are not available to self-employed businesses that set up a solo 401k. For example, the startup cost credit. Because in order to be eligible for the startup cost credit, the business needs to have non-highly compensated employees. In other words, non-owner employees. And a business that has non-owner employees is not eligible to set up a solo 401k. Remember, a solo 401k is for an owner-only business. But there are other credits that became available under the Secure Act. For example, one is the automatic participation credit, also referred to as the automatic enrollment credit, which is not limited to businesses that have non-owner employees. That means an owner-only business that sets up a solo 401k plan with the automatic contribution feature and has all the other required notices, et cetera, and forms like our plan does, would be eligible for the credits. So the credits specifically are a $500 per year credit for 3 consecutive years, totaling $1,500. It could be available to businesses that set up a new plan or businesses that convert an existing plan to include the automatic contribution feature. And unlike the startup cost credit, which is limited to the cost to set up and maintain the plan, the automatic enrollment credit, the solo 401k tax credit, is not based on the actual cost to set up and maintain the plan. So if someone were to set up a new plan here in 2024 that includes the automatic contribution feature like our plan, they'd be eligible to start claiming the $500 per year credit when they file their 2024 taxes, and then again for 2 more years for a total of $1,500. Or if they have an existing plan, right? They have an existing plan, say at Vanguard or Fidelity or Schwab, and then convert to our plan here in 2024, that would enable the self-employed individual to start claiming the $500 per year credit when they file their 2024 taxes next year. And then again for 2 more years, as long as they maintain the plan with that automatic contribution feature. So as mentioned, it's not a function of the cost. So for example, our fee is $650. That includes the $525 establishment fee, plus the first $125 annual fee. So the net cost in the first year is $150. But then in the second and third years, right, our fee is $125. That's the annual fee that's due on the anniversary date. For example, this time next year for a plan that's set up today, that covers the second year. So that's the individual would still be able to claim the $500 credit that would more than offset that $125 annual fee. So again, it's not limited to the cost to set up and maintain the plan. It's also noteworthy that it's a tax credit, not a tax deduction. So with a tax deduction, one is reducing their income upon which their tax liability is calculated. With a tax credit, the individual first determines their tax liability and then is able to reduce that liability dollar for dollar by the amount of the credit. So in that way, a tax credit is much more preferable than a tax deduction. So again, in order to be eligible for the solo 401k tax credit, you've first got to be eligible to set up a plan, and then you set up a solo 401k plan like our plan that includes the automatic contribution feature. What is the automatic contribution feature exactly? Well, it's setting a default 3% contribution amount, but the employee, i.e. the solo 401k owner, has to be given the option to opt out of that default amount. So opting out of the default amount doesn't mean that you're not eligible to claim the credit, right? You're just exercising your rights under the automatic contribution feature. It also doesn't mean that you can't contribute, right? You can contribute more than the default amount. You can contribute less. And as a matter of fact, you're not even required to make annual solo 401k contributions to qualify for the credit. So opting out of the default amount preserves all the flexibility that naturally comes with the solo 401k plan to make contributions of whichever amount or whichever schedule they prefer, of course, subject to the contribution limits and the deadlines. So again, if you have an existing solo 401k plan, it can be upgraded to our plan to be eligible to claim the credit. How do I claim the credit? Well, you start out by filing Form 8881. We have a deep dive video walkthrough that's geared towards all the different business scenarios, right? Whether the business is taxed as a sole prop or an S corp, et cetera. So our clients know exactly what they need to do in order to be able to claim the credit and reap the reward. So just a quick couple examples to illustrate how it works. So if Lindsay, for example, already has a solo 401k plan that doesn't include the automatic contribution feature, for example, she might have a plan at Vanguard. And if she amends her plan here in 2024, she would be able to claim the $500 credit when she files her 2024 taxes. And then again, for 2 more years, as long as she maintains the plan with the automatic contribution feature. Whereas Brad doesn't have a plan, but he's eligible because he's a solo attorney with no employees working for him. So if he signs up here in 2024, he would be able to claim the $500 tax credit when he files his 2024 taxes. And then again, for 2 more years, as long as he maintains the plan with the automatic contribution feature. Okay, excellent. So thank you so much as we went through those slides. Let's start to go through the questions with our remaining time. Thank you so much for bringing all the great questions. Can we contribute to the Roth for both employer and salary deferral? Most definitely, right? Subject, of course, to the limits, right? Provided that the plan, for example, was set up before the end of 2023. If you're trying to make 2023 contributions, but for 2024, you can certainly make both Roth employee as well as Roth employer. But as I noted, I mean, our plan does allow for the mega backdoor Roth. So what we see is a lot of clients just go ahead and prefer to make the voluntary after-tax contribution for the reasons mentioned, right? You don't need as much income to justify the contributions because you can contribute 100% of your self-employment compensation as a voluntary after-tax contribution, whereas the employer contribution is a percentage of the self-employment compensation. But to answer your question, yes, you certainly can. Thank you so much for the good question. I had a non-qualified taxable Roth 401k distribution and made the mandatory withholding payment using EFTPS. How do I report the withheld dollar to my solo 401k? So we have online forms on our website that clients use to let us know about events that require that a 1099-R be issued. And so each different form is geared to each situation. So if it's a taxable distribution, you'll see on the form that you have the opportunity to let us know about taxes withheld, or you can also just add comments when you're submitting the form, as they are generally free-form fields. Hopefully that helps. If you go to the website, mysolo401k.net, in the upper right, you can see the link to forms. Does the calculation have to include self-employed health insurance that is deductible on Schedule 1? Well, you have to, it depends on the situation, but you have to follow that formula, right? Of line 31 of Schedule C, less 1/2 of the self-employment tax. So if that self-employed health insurance amount ultimately reduces what's on line 31 of Schedule C, then it would reduce self-employment compensation and what the individual would be able to contribute. Hopefully that helps. Thank you for bringing the good question. Does that mean we can contribute both salary deferral and employer contribution to after tax and then move to the Roth IRA? So the answer is no. However, one does not have to make employee and employer contributions. They could solely make voluntary after-tax solo 401k contributions and then be able to transfer those voluntary after-tax solo 401k funds to a Roth IRA. Hopefully that helps. Thank you for the good question. If voluntary after-tax is part of the employee contribution, how can voluntary after-tax be higher than $22,500 for 2023? Great question. It's because the voluntary after-tax solo 401k contribution limit comes from a different section of the code, comes from the overall limit, the 415C limit, which applies per employer, for example, as opposed to the employee limit, which applies at the employee level. This is why if someone maxes out contributions to, say, their day job 401k plan, they're not going to be able to make any more employee contributions to the solo 401k, but they could still make the voluntary after-tax solo 401k contributions because that comes from a different section of the code, which is the overall limit. That's why it's higher. Hopefully that makes sense. The extra $7,500 does not have to be reduced by the one half of the self-employment tax. Well, you first determine your self-employment compensation, right? Line 31 of Schedule C, less one half of the self-employment tax. Once that amount has been determined, right? Let's say that amount is $50,000. Let's say the individual is greater than 50 years of age. Let's say they want to make contributions for 2024. So if they didn't make any employee contributions to another plan, like a day job plan, they're going to be able to contribute 100% up to $30,500, right? Because their self-employment compensation is greater than $30,500. So they can do the full amount. There's no more reduction, right? You already reduced it when you first calculated 50,000, right? Because remember, in our simple example, 50,000 is after you've taken line 31 of Schedule C less one half of the self-employment tax. So that's the first step, is running that self-employment compensation calculation. And then once you've determined self-employment compensation, then you can determine, okay, what can I contribute to each of these different buckets, et cetera, et cetera. Can you talk about 5500EZ reporting? Is it a total of all solo 401k sub-account balance, including 401k balance from the employer? Well, it's a total of all the solo 401k account balances, right? It could be for different participants. Like say you have a husband and wife that are both working in the same business, both participating in the solo 401k, or different account types, right? Whether it's pre-tax, Roth, and after tax. But one doesn't have to include the 401k balance from, say, a day job 401k plan. One doesn't have to include the IRA account balance that they might have. So it's just the solo 401k account balance. If we're paying our children a salary, thank you for all these great questions. Can they also take advantage of our solo 401k Roth? Well, they would need to be at least 21 years of age or older. They would need to be working in the business, reporting their own earned self-employment income, and they would need to be at least a 3% owner or more. Because, so in other words, it wouldn't be for minor children, right? They'd have to be eligible to participate in the plan. In order to still qualify as a solo 401k, they'd have to come in as a business partner, because the technical term for a solo 401k is a one participant plan. Now, there are exceptions to that one participant requirement. One exception is for a spouse that's working in the business. The other exception would be for a business partner. So in order for your child to be able to participate in the plan and it still qualify as a solo 401k, the child would need to be a business partner who's working in the business, reporting their own earned self-employment income, and at least a 3% or more owner of the business. But assuming the child satisfies those requirements, then the child can certainly participate, be able to make contributions based on the child's situation, right? Their age, their self-employment compensation, whether they make contributions to another plan like a day job plan, et cetera. Hopefully that makes sense. I'm over 60 years of old, maxed out on a day job 401k, want to contribute max to the voluntary after tax. Do I have to contribute this catch up $7,500 to the employer pre-tax or Roth? Well, if the individual has maxed out their contributions to their day job plan, first of all, I would presume that would include the $7,500 catch up. So if they maxed out the $7,500 catch up amount to the day job plan, they're not going to be able to make the $7,500 catch up again to the solo 401k. But if they didn't make that $7,500 catch up to the day job plan, and they had the self-employment income to justify the contribution, they could make the $7,500 catch up to the solo 401k, but it would have to be made either to the pre-tax employee, not employer, or Roth employee bucket. So not the after tax or the employer, in other words. Hopefully that makes sense. That takes us to the end of the questions. Thank you so much for all the great participation. Please like and subscribe for more videos like this. You can welcome to join us in our community, of course. We go live every day, 1 p.m. Pacific, 4 p.m. Eastern. It's always free to join. All are welcome. We have tremendous resources in there, like our forums, our deep dive videos and webinars, et cetera, et cetera. Let's see if we have any more questions before we wrap for today. And if you subscribe to the YouTube channel, you get notifications of all our upcoming sessions here. Does the children being paid out of the business, not owner, over 3% disqualify the plan since they're an employee? Does it matter their age? Well, if they are minors working in the business, then regardless of the number of hours that they work, the solo 401k plan could still be maintained. But if they are 21 years of age or older and they're being paid as W-2 employees and they're working on a full-time basis, then the solo 401k plan could not be maintained because now you have non-owner, non-spouse, full-time W-2 employees. So now these businesses would no longer be eligible to maintain the solo 401k plan. So there's different options. So for example, of course, one could write a check, mail it to the back office. You'd want to include a cover letter that specifies the account in which the check needs to be deposited. One could take the check to the branch, again, bring the account number that you want to deposit or you want the check to be deposited into. One could work with Schwab to set up, to link an external account using the money link form. So now using that money link form, you may link to say your business account. Sometimes Schwab will want that external account, the name on the external account to match the name on the account at Schwab that's being linked, right? And when they see that, say the name on the external account is the business name and the name on the account at Schwab is the plan name, they may first reject that. So based on experience, we've coached our clients to point out to Schwab that when the account was set up at Schwab, it listed that business account. So really that business account is on, that business name is on the account. And based on feedback and experience, then oftentimes Schwab will then allow that external business account to link to the account for the solo 401k. And a fourth option would be to deposit money into a non-retirement brokerage account at Schwab and then move it over internally from the non-retirement brokerage account to the brokerage account for the solo 401k. But thank you so much for that feedback. We appreciate it. Can employer or employee contributions made for 2024 be submitted in January to March of 2025? So yes, assuming that the plan is set up on or before the end of 2024, then all types of solo 401k contributions, whether it's employee or employer, can be made anytime up until the business tax return deadline, including any timely filed extension in 2025. What is the difference between opening an individual 401k plan directly with Schwab versus going through my solo 401k? So wonderful. This is a great question, and we have a lot of good information on our website, and we're planning on visiting this on our YouTube channel again, refreshing the topic. But there are a number of differences, right? One, for example, is that Schwab does not allow for, and actually, let me pull up a good page here. 1 second, and I'll link over to it. Thank you so much for your patience. Let me go to pull up our website here, mysolo401k.net. And you'll see at the top here, there's a link to our resource hub for existing Vanguard customers. So this is actually relevant to the question because one of the sections here compares a Schwab Solo 401k versus one provided by us. So you can see, and I'll chat over this link. You can get to it right from the website though too. It's right at the top there. But the account opening process, right? We pre-fill the paperwork to open up the account at Schwab, whereas one would not only need to fill out the account opening paperwork, but the adoption agreement, et cetera, versus our 1-minute application. Certainly brokerage accounts can be at Schwab using our plan. The net cost over the first 7 years is going to be $0 with us after you factor in the $1,500 tax credit. So while Schwab is now allowing for Roth employee contributions, They don't allow for Roth employer. So that's one difference here. Another is they don't allow for mega backdoor Roth contributions. They don't allow for in-plan Roth rollovers, right? So this is where you're moving money from the pre-tax Solo 401k sub account to the Roth Solo 401k sub account. So for some folks, they, along with their advisors, their planners, CPA, financial advisors, when their income is low in certain years, may want them to move money from their pre-tax Solo 401k account to the Roth Solo 401k account. It becomes taxable during the year that they move it over, but then you got the potential for tax-free growth going forward. So again, with the Schwab, even though they allow for Roth employee contributions, they're not allowing for in-plan Roth rollovers. No Solo 401k participant loans at Schwab, whereas our plan does. No alternative investments like real estate at Schwab, whereas our plan does. They're not going to handle the 5500EZ, whereas we handled that as part of our service, preparation and filing under the electronic filing system. No $1,500 tax credit. You can't have your accounts anywhere else, right? With our plan, you can have the brokerage account at Schwab, but you can also have a bank account or an account somewhere else. Could be another brokerage, could be a cryptocurrency exchange account, etc. So that's a great resource, I would say, to help answer your question. And Schwab states they won't accept deposits from Schwab brokerage accounts. Yeah, that's not been I mean, I appreciate certainly appreciate your feedback. While it's certainly possible Schwab changed the rules, we have a lot of history with clients that are able to do that. So again, the money link could be an option. It could just be that person that you're working with is giving you misinformation. But please don't hesitate to reach out so we can help jump in to help resolve it. Thank you so much for participating. So the key is not having any eligible employees that are full-time. So individuals are not going to be eligible under our plan document until they're at least 21 years of age. So the children could be working as W-2 employees in the business, regardless of the number of hours, as long as they're under 21 years of age. Hopefully that helps. So thank you so much for all the good participation. That does bring us to the end of today's session. Please continue to engage. Thank you so much. And we'll take it from there. Thank you so much.